Insert topic.
You're a pretty smart guy. You're a genius. That's quite an intro.
Well, when it works, it works.
So I will add, I am Luke's father. So yeah. So last week, I discussed with you why the market is cooling and the evidence that we had in real time that the market is cooling off. And we looked at 8 days a quarter ago. We're now selling in 50, or houses that were selling in 10 days are now selling in 30, or haven't sold still after 30. But that also brings up the question as well, how cool off is cool off? Are we headed for a crash? And I'm going to share with you today why I believe we are not headed into a crash of the proportions that we've lived through in our lifetime. Mm-hmm. All right. So I'm gonna actually share with you a few things why there'll be some blips. It's going to be a little rocky road. I mentioned before we went live, we might want to gird our loins just a bit, because that's just what you do in business when markets shift. But yeah, I think that our overall picture is fairly healthy. So with that in mind, I will begin the little screen share here with you with my fancy slides. And I guess you could see that, right? You can see the fancy animation that I put in there.
There it is. It's happening. And just because you mentioned share, if everybody who's watching would please like, share, and subscribe. This is a brand new YouTube channel for Real Estate Unscripted. So we do need some subscribers so we can, get Google to work on our side. But there you go.
All love is appreciated. All right. So today I'm going to discuss why there won't be a crash. And to have a crash, you kind of need to look at history a little bit to understand what I mean by a crash. In the last 100 years, there have been 3 crashes of note. And they're easy to recall. We weren't around, but the Great Depression, when we were in our salad days, Tim, would you say, in the late 80s? And then, of course, the Great Recession of about 13, 14, 15 years ago that went on for what I think was probably easily an Olympiad. Took us a while.
Yeah.
So, but here are the eras that we had without crashes where people might have thought there might have been a crash. Intuitively, people don't realize there was no real estate crash in World War II. In the unrest of the 60s and 70s, there was no real estate crash. And that's not just because I'm not referring to, a lot of people grew their hair. I'm talking about there was a massive redistribution of wealth at that time. And Medicare and Social Security were expanded. Medicare was rolled out. The welfare state, if you will, was broadly expanded. And we had the expense of the war. The housing market was still robust. The war on terror, the war on drugs, the pandemic. It is clear that housing is very, very resilient. So what causes a crash? Historically, crashes have these things in common. First of all, it starts with Wall Street having a catastrophe, okay? Once that catastrophe occurs, it becomes clear that there were already weak financial underpinnings that you need to look for in order to brace yourselves, okay? Once the crash occurs, there is a systemic bank failure, right? And what results from that is a foreclosure tsunami. The banks don't fail because stocks go down. The banks fail because the Wall Street crash causes a recession where people don't pay their bills and the banks have a lot of loans that default, okay? So those are the commonalities. So let's look at the Great Depression. October 29th, 29. I think that was called Black Tuesday, Black Friday, Black something or other. Black Friday, right?
Yep.
There was a global financial crisis, was the financial underpinning that was so bad. The world economy still had not recovered from the catastrophic effects of the First World War. Okay. There were 744 banks that failed in the ensuing 10 months, and foreclosures doubled. A little extra stat about that. The foreclosure rate prior to the Great Depression was about 3 out of 1,000, and it went up to about 10 out of 1,000. Now, foreclosures doubled, and the math doesn't seem to match, but a lot more people became renters probably after that. So that is why the foreclosure rate essentially tripled, but the raw number doubled. Okay. Now, the first crash of our lifetime worth speaking of was the late 80s. Okay. Conspicuous consumption in the 80s. We had Black Monday. Also October of 87. Stock market lost about 25%, 22, 23% of its value in one day. Okay. One problem that was emblematic of the weak financial underpinnings of the economy were like junk bonds. But overall, savings and loans as a business model were absolutely a mess. Roughly 1 out of 3 savings and loans failed in the late 80s. Now, a lot of these were smaller thrifts. A lot of these were community banks. Savings and loans by nature were kind of localized banks, but 1,000 banks failed. And there was a 25% average loss in property value that took us about 10 years to dig out from under. So it wasn't until about the mid to late 90s that we saw property values recover. And that is the crash of our lifetime that we should have learned more lessons from. All right. But the three things: catastrophic Wall Street failure, banks failing, and then enormous foreclosures. So then we get to the Great Recession. Okay. So September, it's interesting. There was a day in September in 2008. The economy was already reeling because the subprime dominoes had been falling for nearly a year. And there was a day where if the government did not act quickly for about $1 trillion bailout, that the talk was we would go back to a barter economy. It was that bad.
Yeah.
And the subprime collapse was emblematic of the weak financial underpinnings. There were billions of dollars in bad paper floating around out there. And it had been all put out in 2003 and 4 and 5 to artificially lengthen the real estate bubble that we talked about at the time.
Right.
And when those rates adjusted and you had to pay the piper, piper didn't get paid. 465 banks failed. And that's not as many bank failures, but some of these banks that failed were absolutely humongous. Washington Mutual, Indy Mac, other mortgage companies, who was it? Countrywide, enormous, Wachovia, enormous bank failures. And of course, well over 6 million foreclosures. So you've got those three things. And the domino effect of it all is that when Wall Street gets sick, it is a symptom of the overall economy being gravely ill. Then you have this enormous recession. And what does Warren Buffett say? When the tide goes out, you know who's swimming naked? We were caught with our pants down as a society because there were so many unqualified borrowers who couldn't make good on their financial obligations. Right. Stated loans, stated income, all of this, a lot of garbage out there. So why I believe 2022 is different is that, first of all, the financial underpinnings are relatively okay. We have some volatility on the stock market for sure, and we've seen bad days on the stock market where significant losses were realized. However, those were sort of more like anomalies than actually being the picture or a symptom of billions and trillions of dollars in bad paper out there. So the financial underpinnings right now, we don't have. Most mortgages, for example, are full documentation, conventional or FHA type mortgages out there. There's not a lot of gimmicky mortgages out there. Now, where the pandemic actually helped us was that right now, the number of homes that are facing foreclosure are microscopically smaller than in past eras. That is in large part because of the COVID era moratoriums on foreclosures.
Mm-hmm.
And I will add that, yes, distress will return to the market, but it is being managed in a far more, I think, coherent and measured way than before. So there's not a lot of shadow danger stuff that's going to charge over the hill with the facts that I see on the ground. And housing is resilient. So as long as people can borrow, and what do you need to borrow? You need a bank that can borrow, that can lend you money, right? So as long as people can borrow, then housing will remain resilient. Okay. And that is that. The takeaway, really, overall, is that the idea that going into what could very well be a recession is going to make real estate such an unpalatable investment that people are going to flee from it, as they did in the past catastrophes, I think is false, because you can't live in your 401k. It gets very drafty. People are going to live indoors. And as long as they can borrow money, and as long as we're not in a massive systemic catastrophic failure of the proportions that I just discussed, we'll have some blips. But overall, I think we're going to be okay. So that is my non-economist English major, but I've lived through 2 horrific crashes and lived to tell about it commentary on why we should be careful but not panicked. Now, you have a thought that may not be rosy.
Well,
there, but tell me why you think we might be a little bit more in danger than I think.
Well, let's throw some numbers at this. Sure. If we've obviously gone into a real estate bubble and it's going to come down, what year are we going back to in housing pricing levels? So what's the average house price now in Westchester?
$700 and some odd $1,000, yeah.
Right. So pre-pandemic, where would that have been?
I think $100,000 less. I think it's in the low 7s now, and I think pre-pandemic, I think it was probably in the mid 6s. I could be wrong, but
right. Well, just general.
I think easily in the 6s.
You know?
Yeah.
But yeah, so where do you think that this softening blips are going to take us back to?
I think we're going to flatten out. I think in some markets, a lot of it has to do with supply and demand.
Mm-hmm.
And right now, without a big catastrophic thing where a lot of people are going to liquidate because they've lost their job or they can't make their payments, without that domino falling, I think things will just sort of flatten out. There's still very little inventory. And in the absence of inventory, the only way to convince someone to sell, because it's a pain in the ass, right? They don't have any place to go. They're not sure where they're going to go. With low inventory and fewer choices to make, then prices will be stable, I think. All right.
Yeah.
If a lot of inventory hits the market, that will destabilize the pricing base. And it's a function of what does that look like? How would it happen? Because it's certainly not going to be with foreclosures. How will it happen? And how long will it take to wring out the distress?
Mm-hmm.
So let's take the case that let's look at a reasonably measured worst case scenario. I'm not talking about a black swan event, a big terrorist attack, or another monkeypox pandemic, or whatever was coming down the pike, or, maybe the student loan bubble suddenly destabilizes everything. I don't see that happening either. But let's just suppose that we do have a doozy of a recession coming, and maybe we have 3 or 4 quarters of stagnation.
Right.
Okay. We have that. And there's a little an increase in foreclosures. Right. I know in New York, it's going to take years to adjudicate, to resolve all of those foreclosures.
Sure.
They can't fast track them the way they did in 2007 and 8 because of the robo signing scandal. So there's going to be a lot more oversight on how the banks liquidate their distressed inventory. So in the absence of being able to wholesale just flood the market with tons of distressed assets, it's going to come in more drips and drabs. Now, I'm cheating a little because the brand does have an REO department. And we've been to conferences where we heard, for example, the REO guy of Freddie Mac talk about the usual inventory of distressed assets for Freddie Mac. Usually, I don't know, let's call it 30 to 50,000 units.
Right.
And at its apex in the Great Recession, it was over 100,000. And last September, that number had dropped to under 5,000, like 1,500. But there was a moratorium.
Right.
So let's just suppose it goes back to 15 or 20 or 30,000. You've got some.
I am a popular guy this morning.
You're a popular guy. I only hang with the cool people anyway, right? So even if foreclosures go back to 10 or 20 or 30, 40,000, we have the population and the setup to absorb it, but that will remove this cartoonish, caricature, crazy exuberance that we're seeing of prices spiking because rates are higher now, and you're not going to have as many buyers, right?
Right.
So it'll be knocked off kilter if we do have that kind of a recession. But will it be at historical proportions, or will it be more like, maybe a mid-70s type of a situation where, people still lived indoors? There wasn't this big housing crisis. So that is my take. And I think if we learn from history doesn't repeat itself, but it echoes.
Right.
And having lived through the pain of what a massive recession and housing crash is like, because it's like, having lived through that, you get this, I am never going to go through this again.
Yeah.
And when and if this ever happens again, I'm going to be so prepared that I'm going to actually profit from it. All right. There's no way I'm going to go through this again. That is what a self-employed person says who has endured this. So,
right.
You're always watching. You're always like, this is stuff I look for because I never want to be caught with my pants down. So, we're doubling down on distress in case this happens. We've already got a big infrastructure for short sales in case this happens. But I'm also looking for the cracks in the armor. I'm looking for the echoes.
Right.
And I don't hear them. I don't hear them. We'll see.
If I could just add that, in I think it was in 92, I read the Harvard study that, when boomers retire, real estate's going to take a big hit. And I think that it was the financial system that set that up, saying, look, if they're all going to retire, if they read that report, we have to get everybody in or out of their first or second home or their extra home or whatever it is. And they're going to, the robo signing, changing, collecting fees on fees just because they wanted to get stuff done, because they knew in 2008 that all these people were setting into fixed income, and real estate was not good because they're the biggest and most powerful generation.
Yep.
Right. And then the next generation below that is the Gen Xers, right? Who right now, right. All right. So then who's after them?
Millennials.
We should know that. Millennials. So the millennials don't come. So Gen Xers like floated, rode the wave past them. But the millennials are now 35 years old, starting their families, are all moving into their first homes.
Yep.
And I think that the pandemic, while everything kind of slowed down, that forced a lot of people to move out of the big cities, make their real estate moves, prepping for, I need space, I want this, I want that, like figuring out their life goals like real quick because, life was changing and nobody knew what was going on. But
True.
That being said, I think that generation looked at that saying, I have to figure out where I'm going to be for the next few years. So that their market momentum has been cemented into place. And I think that they're in that life of, either starting their family or whatever it is and got their first home, and they're not looking to, run up, especially looking down the line at a recession. They're not looking to go, oh, when am I going to get my second house? So, real estate's on fire, because real estate fire's out and we're coasting now through this. And these millennials are, set in obviously there'll still be some, and obviously they need to live indoors. But the momentum that they were carrying into their part of the market, where they become the biggest and most powerful generation in a marketplace, they've had to put a freeze on everything.
Yeah, it's going to take a while. Yeah,
it's going to take a while. So I don't see a crash, like you're saying. Crash is a very a dirty word. I don't see a crash coming, but I definitely see a very flat and not painful, but just boring market where it kind of just drips down to, where's it happening? Because a lot of people, they did get better mortgages, right? Because we probably see the Fed going to hike something which doesn't relate to bank mortgages, but does in a way. But it touched over 6%, I think, in the last month, and now has pulled back, which is nice. But if they do another rate hike, then that plays with that stuff. But anybody who's gotten in the previous 3 or 4 years is sitting on a nice mortgage, and why would they want to cash out of that to get something more expensive?
I'll say this: boring overall is good. In housing, volatility is your enemy, up or down.
Right.
And boring, I'll take boring.
Right. And I was, it's funny because everybody says buyer's market, seller's market, right? So, okay, so, seller's market is over because, of what is going on now. And the pandemic is lifted all the restrictions, but sellers are starting to not be able to command their prices. But buyers are not going to be able to come in and offer what they want. So we're not in a buyer's market, we're in a broker's market, right?
Yeah, we're in a balanced
window
market,
in between.
Right?
Yeah.
Yeah.
I think you don't want to say brokers, but you need a good broker right now to find a good deal and
well, I think every market's a broker's market from that point of view. But it is more of an evenly leveraged market where buyers do not have sellers over a barrel the way they did 15 years ago.
Right.
But sellers do not have the enormous leverage that they had 6 or 8 months ago. Right. I think it'll be, sellers have the asset, right? If you've got, 2 kids and a third on the way, and you want to move to a suburb, and there's not a lot to choose from, sellers still have the advantage. But I will say this: it'll be a seller's market if your house is well appointed, well located, and priced aggressively. And it's going to be a buyer's market if you have a poorly presented, tone deaf priced house and you do not listen to your agent or stage or clean up or, agree to showings. Denying showings, for example, declining showings is, if it ain't suicidal, it's pretty close to it. It is self-destructive.
Right. You have to understand that you have to participate in the market to get it done. And if you're not going to participate,
buy what they don't see.
Right. And people don't want to see a mess, right? They, obviously everybody who stages and takes care of things and puts their best foot forward obviously gets the first bid. before somebody wants a project on their hands.
Yeah.
So yeah, and that, you know, bringing that back to it, you know, a lot of my builder friends are, you know, pumping the brakes on going out and grabbing something that they want to fix up and flip. So that makes it interesting too.
A little bit of wait and see here for a while, huh?
Yeah, a lot of that. But I mean, we're obviously trying to manage our ways, you know, not into a deep recession, right? We're trying to manage that. So we'll see how they do on a soft landing or whatever they want to call it these days. But yeah, I mean, I think that the real estate market is going to be tough. And I just was trying to pick a number on where pre-pandemic levels it might dribble down to. That's what I was going after.
Well, the pandemic started March of 20.
Right.
And I would say, you know, somewhere around 2019, if it slides back, that would be the worst case scenario.
Okay. Good. Well, you know, we hope that
year.
Doesn't happen, but if you had to pick a year, right? That's what I'm after. It's like don't be surprised if we're at, you know, 2019 levels, and if you have to make moves, you know, you can pick levels like that. I mean, it's going to be interesting because we all know how much pressure from the last adjustment the appraisers are under, right? So now they've got to go from everything's locked up in pandemic times to appraising now, which, you know, is a changing market. So they're under the gun again, right? So it's going to be interesting.
Yeah.
So very good. Good time again. Great discussion.
Good one for the books, Timothy. We did well.
I think so. I think there'll be a lot of rewatches, and of course, if you make a comment, like, share, or like that. But if you have any questions or any predictions yourself, put them in the comments here on we're broadcasting on YouTube, Twitter, your Facebook page, and of course, I'm going to put this out on Home Search TV as well for you. So we're getting it out there, and of course, we're going to have special guests coming up. If you have any ideas, questions, or things you want answered, please reach out to us, and we'll get it done. But there you have it. Thank you, Phil. Any parting thoughts? You want to share your email address, phone number, address?
Oh, easy. jphillip@jphillip.net is the best way to reach me.
There you go.
Wow, you had that ready.
I got a couple things to click on. You just tell me what to do.
That's pretty good. So if you need to reach out and get a broker's opinion, that is, or more, that's the way to reach me. So.
Very good. All right. Until next week. We'll see you then. And
not bad for improvisation. Although I made the slide